The first primary financial statement is balance sheet. Balance sheet shows position, assets versus liabilities plus equity. It is a basic summary of value and ownership. It's usually prepared at the end of month, quarter, half year end, and year end. Here is the sample balance sheet. In the header, we have the business name, the name of the financial statements, and the point of time we are looking at. In this example, the name of the business is Maggie's Consulting, and this balance sheet is as at 30th of June 2025. On the left-hand side, we have the assets section. On the right-hand side, we have the liabilities and owner's equity section. On the left-hand side, it lists what the business owns, and on the right-hand side, it lists everything what the business owns. The assets always equal to liabilities plus equity. Assets are what the company owns or uses to make money. It has current assets and non-current assets. Current assets are the type of assets that are expected to be converted into cash, sold, or used up within 12 months or within the business normal operating cycle. For example, cash and cash equivalents, accounts receivable, inventory, prepayments, short-term investments, and other receivables. Non-current assets are the assets that cannot be fully converted into cash or used up within 12 months. They bring long-term economic benefits. For example, PPE, property, plant, and equipment, which include buildings, machinery, furniture and fittings, computers, office equipment. Intangible assets like software, goodwill, patents, and long-term investment. Liabilities is what the company owns to others. For example, suppliers, employees, tax office. It has current liabilities and non-current liabilities. Current liabilities are liabilities that must be paid within 12 months. For example, accounts payable, accrued expenses, income tax payable. Non-current liabilities are the liabilities that will be paid after 12 months. For example, long-term debt, deferred tax liabilities. Equity are what the company owns to the stakeholders of the company. In this example, we have capital contribution and retained earnings. Capital contribution is the original capital injection that the owners or shareholders put into a business. Retained earnings is all the profits the company has earned since it started, minus all dividends it has paid out.